and getting to Eaton, which, you covered and that's in our portfolio, but you actually was listening to the conference call and you actually said to me, you got to listen to this conference call, what these guys are saying. It just doesn't really make sense. I mean, the company's still intact. You're seeing record results, but, talk about that with Eaton, because it was surprising when you see a company report record results and then come out in that conference call and say kind of that's the top.
Yes. This is a great story to follow because as we've talked about the economy, how interest rates and everything affect that and flow through the economy, GDP is down, we're in a recession, technically, blah, 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 blah. Then you read Eaton's, and these guys are a global intelligent power management company, and they have three main drivers or segments, and it's electrification, thinking electric vehicles, Mm-hmm. It's energy transition, so think of oil to cleaner, and then digitalization, just kind of like the Cisco that remember when you I like how you say he said in 10 years every 100 million products are going to be connected or whatever.
Yep.
And they talked about a recession a little bit. So back up one quarter. Last quarter is when it just sounded so off the wall from everything else you were hearing as far as the economy. They have record backlogs still to this day. It's growing like crazy. They're still seeing organic growth. The language was a little different and their tone was a little different in this previous call versus quarter two, just because management says, hey, we expect a recession, but they don't think it's going to hurt. They didn't lower guidance significantly or do anything like that. But they had adjusted earnings per share was an all-time record, and it's up 15% year over year. Mm-hmm. These are not easy comparables year over year to this company because they're essential. They never had, you could argue they have pull through from COVID, but they weren't, mitigated by it. Sales grew 8%. Organic growth was 15%, Frank.
Yeah. Yep.
All-time record segment margins of 21.2%. That's
important because
over 1%.
If you look at Eaton really quickly, let me explain that when it comes to organic, inorganic, you hear that. A lot of even Oracle, some companies do this, it's called roll-up strategy, and they'll continue to buy companies, and that's how they fund their growth. And if you're great at integrating like Oracle is, then you create a giant. But a lot of companies fail at this.
Right. And you have to watch leverage. They have about 2 to 1 leverage.
Interest rates, but these guys, right? So when they say organic, it's a big deal. It's a much bigger deal than inorganic growth. Is basically like you're buying the growth, right? So,
Yep. All time. So the segment margins were over 21%. That was an all-time record. That's up over 1% or 1.3% year over year. That's significant. That doesn't sound like a lot, but when you're doing the volume in billions of dollars, that adds up a lot. The other thing they're saying, the interesting was when you look at their pulse on the economy, if you look through their transcript, they talk about a recession. They're not worried about that. They talked about EV cars and auto manufacturing chips and things like that. They expect the semiconductor issue and supply chains for autos to last through 2023. You've pointed out a lot how that's not the same language you hear from different auto dealers and things like that. To show you where margins can grow, Frank, what do you think? Well, that's a cheap question. I got to back up there. I'll just tell you because I don't know how to tease it very well.
Okay,
they do a lot of work with autos on the combustion engine side.
Yep.
They make 18 times more. Now, they don't break it down, but even if it's $1 over the course of running auto manufacturing and significantly doing that or being exposed to that, they make 18 times more revenue on an electric vehicle car than they do a combustion engine, they said. And they're looking to grow that big business segment, e-mobility, between $2 and $4 billion year over year.
Yeah, and that's a part in a car. Right?
Exactly.
So you're not looking at, how come, it's not like they're making the whole car. But
they're part. I'm sorry. They're not manufacturing auto. I'm sorry. They're in the stuff. They do everything that sets up all the manufacturing.
Yep.
Things,
so they make, absolutely. What I saw, and finish your point first.
No, I was just going to say, this is a dollar stock club pick, excuse me. I think it's about flat, maybe up 3%, but it went up. Well, it probably didn't finish up today with the market as everything else closed, but but it's doing well amidst all the market volatility. Mm-hmm. That was my last point.
If you look at margins, right, and quarterly earnings per share, you mentioned this. So here's a company that said they achieved record quarterly earnings per share margins. They saw significant strength across commercial, industrial, utility, and residential markets, basically almost all the markets. Total company margins also surprised a little bit higher, 21.2 compared to 21% estimate. And they said the supply chain inflationary environment is improving. The inflationary environment is improving. I haven't heard too many companies said that, right? So right there, you would think, wow, gangbuster quarter thing is going to go through the roof. But then they said, right? They said, and this is CEO coming out, that they expect a recession next year. Mm-hmm. Now, we follow these companies. We listen to what they say in conference calls. I want to say that is the first industrial company that actually said that they expect a recession next year. I haven't seen that. I haven't say, well, it looks like a soft landing, or we could. They're like, we're going to have a recession next year. If you're a CEO and you think you're going to have a recession next year, what are you going to do? You're cutting costs, right? And this is a company with record results. So if you're looking at earnings, what they're telling you is earnings just peaked. They're not going to get any higher. Doesn't mean the stock can't go higher, because maybe they have a significant advantage over the competitors. They're doing much better, so they deserve a higher premium, a higher multiple. But this is a company that's getting it right across all the divisions, and they're saying that basically things have peaked. And this is a company that's getting it right. Think about the companies that are not getting it right. Now you're going to see earnings come down tremendously. They're going to come down tremendously just where interest rates. So the fact that they're going higher, you're destroying demand. You're destroying consumer demand, business demand. Any company that has a backlog, you have to cut that backlog by at least 25% because those orders are not going to get filled. That's the market that we're going to be in. Not everybody's going to be impacted. Most companies are going to be impacted. They're pockets of strength. Again, this is the first market that we've ever seen not ever seen, but it's seen in 12, 13 years where the Fed is not there to support us and not hand out free money. They cannot do that anymore. Okay. You can't even get it from politicians, where we know it's going to be a huge day coming next week for the Republicans. You're seeing it. Even the Democratic polls, which usually, no matter what, will never tell you that Republicans are ahead, but you see this massive push into your Republicans, which is going to be a split government. So you're not going to see a lot of spending coming out of government. You're not going to see, China. Where's the growth coming from China? Where, the real estate market, everything is horrible in China. COVID policy, who the hell knows what it is? But I know that a lot of stuff is still closed there. Where's the growth going to come from? And this is what's scary, because when the Fed's there to pick you up, like they were in 2008, 2009, when they're there to pick you up in 2020, when COVID hit, they're not going to be there to pick you up. Okay, so where is the demand coming from when we're not even talking? We're talking about rates, interest rates. We're not talking about the Fed massively shrinking its balance sheet, which they haven't really begun yet. And you're going to see that shrink by the trillions. So, that means they're not going to be flooding the market with cash. That's a scary sign. So companies see this. They should see this. Eaton's a great company. They got a good management team. If you see this across the board, if you're a company, you have to be conservative here and you have to be cutting costs. You can't mess around. You could be wrong. You could always hire. But right now, if you look at the companies and what they're seeing, the projections right now are showing for 3 straight quarters of negative GDP going for right now, 3 straight quarters of negative GDP. Wait until that hits the news. People don't really know that. They're like, GDP 2% and over 2%. We did great. And, it's coming off 2 negative quarters. If that's correct, we're looking at what? 5 out of 6 quarters of negative GDP growth? I mean, with the Fed raising rates while this is happening? I mean, maybe not as the last quarter's coming in, but they're going to be raising rates for at least the next 3 to 6 months, as Powell says. So, it's interesting to see how a company like this is getting everything right. That's basically telling you, hey, our earnings peaked, and it doesn't get better than that. Think about the companies that are not doing great and how much worse it's going to get for them. And that's how you should look at the markets right now.